Welcome to this video on interest rate risk, which is intended for those involved in the asset liability management function, including personnel and members of a bank's asset liability committee. In this video, we'll discuss risk limits and mitigation strategies, and how each of these are used for interest rate risk management.
A bank's interest rate risk exposure, as identified in models, is generally managed within the bounds of board-approved risk limits. A well-managed bank finds a balance in setting risk limits that are neither so high that the limits are meaningless, nor so low that exceeding the limits is considered routine and not worthy of attention. The most effective risk limits are tailored to specific interest rate scenarios, are based on volatility, and serve as an early warning indicator of undesirable risk positions. Mitigation strategies, used in conjunction with risk limits, are developed in the event limits are breached or interest rate risk approaches excessive levels.
The development of risk limits begins with a discussion of the bank's overall risk tolerance and profile. Generally speaking, the more averse management is to taking on risk, the tighter the risk limits. When establishing risk limits, management teams consider the complexity of the bank and the strength of earnings and capital. Reduced levels of earnings or capital constrain the ability of a bank to accept risk and will generally warrant lower risk triggers.
Developing effective risk limits is an ongoing process that is revisited as economic conditions and the financial performance of the bank change over time. If the bank's risk limits haven't changed for an extended time period, it may be appropriate to consider whether they should be reviewed. Risk limits also prompt management to discuss and develop potential risk mitigation strategies that could be activated to address breaches of the risk limits.
The types of risk limits that management establishes depend on a bank's measurement system and overall risk profile, though limits typically consider impacts to both earnings and capital. Limits based on stressed scenarios are also important so that management can compare the measurement results with the bank's risk tolerance.
Earnings limits are baseline controls that can be applied to the results of income simulation models. Net interest income thresholds are typically used as the primary earnings limits. Net income limits can help to control as well as quantify the risk to the bottom line. They are pertinent for banks with activities that generate material non-interest income that is sensitive to market interest rates, such as mortgage banking programs. Limits can also be applied to capital-based thresholds, such as economic value of equity or EVE models.
When considering EVE thresholds, banks typically base the limit on the percentage change from the base case, or volatility of the EVE, rather than absolute dollar amounts or minimum EVE to asset ratios. This is because using absolute dollar amounts or minimum EVE to asset ratios could potentially ignore excessive risk positions. For example, let's say your bank sets a capital-based limit of minimum 8% EVE to assets. However, it would take a percentage change from base case of 50% to breach this minimum ratio. That's a lot of potential volatility that may not be fully reviewed using a minimum EVE to asset ratio.
Finally, effective management teams establish graduated risk limits. They don't rely on a single limit. Risk limits typically vary depending upon the magnitude of interest rate changes and include severe stress scenarios. For example, bank management might set a risk limit of 15% for a 200 basis point shock, and a 25% limit for a 400 basis point shock. The limit is graduated, since the limit moves higher as the severity of the shock increases.
As financial conditions, economic outlooks, and risk tolerances change over time, risk limits are usually reevaluated for reasonableness. Risk limits need to be set at reasonable levels to allow the board and management time to respond to undesirable risk positions. Earnings performance is one of the primary elements to consider when setting interest rate risk limits. So, it's important to understand the potential impact on net interest margins that is permitted by approved limit thresholds.
A basic approach to estimating this tolerance is to reduce actual margins by the amount of the risk limit. To illustrate this point, this chart shows a hypothetical net interest margin for a community bank. The chart then shows what would happen to the margin if it were reduced by amounts ranging from 5%, 10%, 15%, and 20%. As the dark blue shading reflects, a net interest income decline of 20% would cause substantial margin erosion, resulting in the margin falling substantially.
Let's expand on this concept further by considering the impact of net interest margin changes on the bank's net income. As depicted on the chart, net interest income limits have a much larger impact on the bottom line because net interest income makes up such a large part of operating income in community banks. When the impact of the hypothetical net interest income limits is applied to pre-tax earnings, the severity of the potential erosion becomes quite substantial. Pre-tax earnings would decline more than 60% through what may have been considered an acceptable degree of net interest income exposure at 20%.
In earnings simulations, risk limits are usually based on immediate shock simulations. Ramp limits can also be established as an additional method for monitoring interest rate risk.
Interest rate risk mitigation efforts become important if the exposure approaches or exceeds risk limits, or capital and earnings prove insufficient to withstand adverse changes in interest rates. In such cases, effective management teams seek strategies to reduce the exposure to interest rate risk, increase capital, or both.
Balance sheet alteration is the most commonly used interest rate risk management method. It can include asset sales and purchases, product mix and structure changes, and strategic growth and other initiatives. Such strategies include acquiring liabilities and assets that can offset pricing and maturity mismatches and option characteristics. Another approach, duration matching, attempts to better align the duration of assets with the duration of liabilities.
The use of derivative instruments for hedging is an off-balance sheet strategy that can mitigate interest rate risk.
The most common derivatives used to hedge interest rate risk are interest rate swaps, caps, and floors. These derivatives can reduce a bank's interest rate risk if used correctly. For example, an interest rate swap can effectively shorten the duration of a commercial loan portfolio. This would reduce an asset-liability mismatch. But if used incorrectly, derivatives can compound the risk rather than mitigate it. Given their potential risks, derivatives and their uses need to be well understood by banks that use them, including how cash flows will perform under a variety of scenarios. Derivative use is typically governed by well-developed hedging policies.
Two questions that can be considered when assessing your bank's risk limits and strategy include: are your bank's risk limits periodically reevaluated and updated for reasonableness? Is an explanation to the board and a mitigation plan provided when board-approved risk limits are breached? Remember, effective risk limits control undesirable exposure, promote discussions about risk, and prompt management to take corrective action if limits are approached or breached. Risk mitigation strategies are developed in case this occurs.
As we conclude, we'd like to remind you that the FDIC has additional videos and resources that can be found on the Banker Resource Center at www.fdic.gov. If you need additional information or have questions or comments, please contact your bank's case manager or email the FDIC at supervision@fdic.gov. Thank you for viewing this video. We hope you found it both useful and informative.